Hello, and welcome to the Wild Bat podcast. This is episode 11. Today we're going to be focusing on Module 8 of the Income Tax and CCPC course. Module 8 is about compliance. Corporations have a multitude of tax returns and information returns that need to be filed. As well as that, they have payments that need to be made. And today we're going to be talking about what happens when you do not comply with the CRA and other tax agencies' guidelines. We'll start with the concept of the fiscal period of a corporation. After a corporation has finished their fiscal period, the fiscal period is generally 1 year, they must file their T2 tax return after 6 months. If the revenue is greater than $1 million, they must file it electronically. A CCPC can have any year end that is dated any day of the year, but generally it's a month end. The easiest month will be December because we have tax returns such as, or information returns such as T4, T5, T4A, and to name a few, which are December year ends, which follow the calendar year end. Having a misaligned fiscal year end from a calendar year end can be a little bit confusing. You generally have to do a reconciliation to match up these returns. However, having a year end at a different month than December can be more convenient because you don't have to complete your fiscal year end reporting at the same time you have information return reporting to complete. If you are a professional corporation is any professional practice such as an accountant, dentist, lawyer, doctor that is in a partnership with another professional corporation. They must have a December year end, as well as the partnership of such must also have a December year end. If a corporation fails to file their taxes on time, there is a 5% penalty on the taxes payable, plus 1% of each complete month after the filing deadline. For example, if you have a December year end and you do not file until, just say the 5th of September, then you will have 5% automatically, and then every complete month after the 30 June, which is its filing deadline. So you'll have July and August. So your total penalty will be 7%. If you are a repeated failure to file, look under section 162 part 2, you are defined as a repeated file failure if you failed to file your tax return on time. You have been demanded by the CRA to submit your return. The CRA will send you a letter if you fail to submit your return. And before the penalty was made, there was another penalty within one of the prior 3 years for failure to file. If you meet this definition, then your filing penalty will be double that what it normally would be. Another thing that happens, which is we're getting into now, the concept of filing an error. What a lot of, corporations do, or the management of the corporations do, is they conveniently file less income and hence report less tax to pay on their income return. If this amount is greater than $500 twice in 3 years, there is an immediate 10% penalty on the unreported amount of tax that is is payable. This goes into the concept of gross negligence, which is defined in the CRA as being a very great lack of due care and attention, and can attract up to 50% of a penalty on the tax payable amount that has been unreported. For example, if you file your tax return and you determine it to be, say, $10,000, and you get audited, or they figure out one way or another that it should have been $15,000. Well, not only do you have to pay that extra $5,000, but then you also have to pay $2,500 extra in penalties. This is generally considered a deterrence method to avoid people from underreporting their taxes. If there was no deterrence method, the majority of people would probably underreport their taxes, and the onus is on the taxpayer to calculate their own taxes, comply with the tax code, and file their taxes accurately. Another concept before we move on is interest on taxes, or use of money interest, as it is called in New Zealand. If you don't pay your taxes on time, or you file your taxes late and then you do not pay your taxes on time, what will result is that you will get interest on the payment that is to be made, the payment that is due, the taxes that are due. This interest compounds monthly. It doesn't take very long for a tax bill to increase in value, and as a result can be a very expensive venture if you are grossly negligent. You're incurring penalties, and then you are incurring interest on top of those penalties. We'll move on to this later on, but in Canada, the filing date, your tax returns are due 6 months after year end, but your payment is due 3 months after the year end, or if you're defined as you may also be defined as 2 months, which we'll cover later on. And as a result, you're better off actually filing your taxes and then paying them before 3 months, because you figure out what your taxes are and then you pay them, rather than paying your taxes and then trying to figure out what your taxes are. As a result, it's very important to keep organized on what your taxes are going to be and pay them on time. Now, what I have seen a few times, which is definitely something to consider, is what a lot of corporations do is they determine what their taxes are, and then what a lot of corporations do is they don't file their taxes, they don't make any payments, they make all this money, then they spend all the money, and then the CRA come after them and request that they file tax returns, or audit them, make them file tax returns, and then they have this enormous tax bill, and in some cases the operations are no longer happening anymore. All the money's spent, the client has no money, the taxpayer is now an employee, and then what happens is, the CRA debt, the taxes, they have to be paid. You cannot go bankrupt and write off your taxes. You generally cannot enter a payment arrangement with the CRA to pay only a portion of your taxes. You have to pay the entire amount of taxes that are due and that are computed. If you get yourself into this situation, the CRA will create something on your payslip called a garnishee, which is like an extra deduction on every payslip that you have, and this will go on until your entire tax bill is paid. So you definitely don't get away from tax debt. Another key note when it comes to interest and penalties is that the tax debt is not deductible. You don't get a deduction on your tax return. You don't get you don't get any benefit from paying penalties and interest. Your taxes, you have a choice. You don't have a choice to pay. If you're profitable, you'll generate a tax return and you'll pay the tax on the profitable venture. But your penalties and interest, you do have a choice to pay, because you can be organized, pay your taxes on time, file your taxes on time, and avoid them. These also occur for information returns. We're talking T4s, T4A, T5s, T1135s, payroll remittances. Failure to file these on time do have immediate penalties, which can be very severe. I recently found out that a T1135, a foreign reporting form, incurs penalties of $25 per day that it is late, to a maximum of $2,500. These are very expensive penalties, and I would recommend making sure that you find out what your filing requirements are, make the filing requirements, pay your taxes on time to avoid any interest and penalties. Moving on from interest and penalties, a lot of non-compliance can result in offences being punishable by a fine or imprisonment. If you look under section 238, part 1, if you meet the if you meet the definition of which you are a person who's failed to file a tax return under subsections in the Income Tax Act, there are quite a multiple here, then you are guilty of an offence which could lead to a fine of not less than $1,000, but not more than $1,000, and not more than $25,000, or the fine as well as a term not exceeding 12 months in prison. They generally don't go down this route, but definitely don't push your luck with the CRA. Note that it says every person who has failed to file. So if you're an accountant and you are responsible for filing your client's taxes and you refuse to do so, you could meet the definition and be subject to these penalties and these punishments, But what the CRA are really looking for, and what they're really trying to make an example of, is this concept of mens rea, the criminal intent of people intentionally misappropriating tax returns, intentionally attempting tax evasion in order to avoid paying taxes. If you are defined as having criminal intent and attempting tax evasion, we're looking at a fine of 100% to 200% of the tax payable that would have been paid, the tax difference or the tax that was evaded, and also a term not exceeding 5 years in prison. If you are a director of a corporation, you are responsible for the corporation's tax deductions. If you fail to make payments to the CRA for any of these amounts, the employee source deductions, the tax deductions to the owners or non-residents, Part 7 and Part 8 taxes, which are, Part 7 is refundable tax on corporations issuing qualifying shares, and Part 8 is refundable tax on corporations in respect to the scientific research and experimental development tax credit, or SHRED tax credit, any GST or HST tax. You will be liable for making these payments on behalf of the corporation if you are a director. The directors are jointly and severally responsible for these payments. This means that if you are on the board of directors and there's 5 of you and you are the richest director, the CRA can come after you and find your deep pockets to get the tax deductions that should have been paid on behalf of the corporation. Taxes need to be paid before the deadline, otherwise they start incurring interest on taxes. A CCPC will have 3 months after the year end if it meets the definition under Section 248 Part 1, Part D, I. Otherwise, it will be 2 months. Individuals, you will have the 30th of April, which aligns to also the filing deadline. These have changed during COVID times, but have gone back to normal, so make note of that. For CCPCs and other corporate, I guess also also individuals, installments can be required on any taxes that are payable over $3,000. This is based on what your prior year taxes were. So your first year, you're generally off the hook because you don't know what your taxes are going to be. However, in your second year, they're based on your previous year, what your tax installments have to be. Option 1 is estimating what your taxes are going to be and paying 1/12 per month for the entirety until your taxes are due the following year. Option 2 is determining the actual Part 1 and provincial tax paid, which is the actual amount that was payable at the end of the year, and dividing that by 12. Option 3 is a mix when it comes to if you're filing 2 years in one. The first 2 months are based on the second preceding year, and the remaining 10 months are based on the residual amount of the immediate preceding year minus the tax installments that have already been paid in the first 2 months. Look up Section 157 Part 1 for more information. If penalties do not happen on time, penalties and interests do incur, so definitely don't miss out on them. Alrighty, that's all for now. Please join me next week where I will be discussing acquisition and control when a CCPC is changed over to another owner. Thank you.